But the robo-taxi fleet is really going to be, or the robo-taxi service is going to be, from a margin point of view, more like a SaaS business.
Oh, let's try this again.
Good afternoon, It's John Ford. I just want to clarify, did you say a $2,000 per share price target? Tesla right now is under $200 a share. So
Yes.
Even if you were to 10x that would be an over $5 trillion market cap. Is that what you're saying?
That is what we're saying. We think that the robo-taxi opportunity globally will deliver $8 to $10 trillion in revenue by 2030.
Cathie Wood is at it again, because it seems like only three things are certain in life: taxes, death, and Cathie Wood making bold bets and lying to investors. Cathie Wood and her Ark Invest team have released another research report in which they share their 2027 projections for Tesla, which is Ark's biggest holding with a weight of around 10%, and their report includes a bull, a bear, and a base case price target. And similarly to our approach in our recent video on Ark's price target for the stock of Zoom Communications, we're going to expose the outright naivety, amateurism, and the willingness to scam people of Cathie Wood and her team. Alright, hey there, my name is René Salman, and if Ark Invest superstar Cathie Wood is known for anything, it's her bullishness on the stocks that she favors, and I guess there's no stock she's more bullish on than Tesla. And recently Ark Invest updated their Tesla forecast, and they came up with a new price target of $2,500 per share in the bull case, $1,400 per share in their bear case, and $2,000 per share in their base case. So let us quickly take a look at the details of Cathie Wood's projections to show why the price targets are the biggest nonsense I've seen in quite some time, as the projections are simply unachievable. I like the way Stephen Clapham has put it on his blog. To quote him here, I thought for a second it might be a parody, but I checked and it wasn't dated April 1st. So let's start with the bull case. Ark Invest models, quote unquote, a 25% probability that Tesla could be worth $2,500 per share or more in 2027, which would equal a market capitalization of $7,939 billion according to Ark Invest, or around 25% of the market value of all S&P 500 companies combined, which stands at $34 trillion. For context, as of May 2nd, Tesla has a market capitalization of $512 billion and trades at $162 per share. Now, according to the Ark projections, to reach this bull target, Tesla will sell 20.7 million cars worldwide in 2027. The average selling price will actually decline to $26,000 per car, which would translate to $538 billion in revenue. I think there might actually be a typo in the Ark model, because 20.7 million multiplied by 26,000 is definitely 538 and not 528 billion. Cathie Wood then models 613 billion in autonomous ride-hail revenue, aka revenue generated by robo-taxi services, assuming Tesla ever launches such a service. Just to be clear, as of 2023, this business division simply does not exist. There's no revenue generated by any Tesla ride-hailing servers, and in their most recent quarterly report, the words autonomous or ride-hailing are nowhere to be found. All I could find is that in their most recent 10K, so their annual report, Tesla stated that, quote unquote, we intend to establish in the future an autonomous Tesla ride-hailing network. But again, they state this only once in their entire 10K. And to give you some more context here, Uber, which is unarguably the biggest ride-hailing company in the world, generated around 32 billion in revenue over the last 12 months. So this gives you maybe an idea of how difficult it will be to generate revenues north of 500 billion. So I guess to make the forecast for any individual stock work, you could just create a new business division out of thin air that in 5 years will generate more revenue than the current largest US listed company, Apple. In Ark's bull case scenario, Tesla will launch this division in Q4 of 2023, as if there were no regulatory or technical hurdles. And as we just said, according to this model, this business division will generate more than $600 billion in revenue in 5 years. And in the worst case, robo-taxis will only be launched in 2030. Now combine the revenue of both segments and you get a revenue of around 1.15 trillion US dollars. Now to assess how achievable these forecasts are, we could take all sorts of different approaches here. For example, you could take a closer look at the modeled autonomous ride-hailing revenue, make assumptions with regard to the fleet's size, the amount charged per passenger mile, the fee that Tesla could get per mile, and then build a complex model to figure out how many passenger miles each robo-taxi would have to drive per day to make Ark's numbers work. I've seen this approach on a Clear Technica blog post that examined Ark's 2025 projections, and the author came to the conclusion that the $327 billion in autonomous ride-hail revenue that Ark modeled back then is absolutely huge and likely unattainable. Similarly, Stephen Clapham also crunched some numbers in his blog post, and he came to the following conclusion, quote unquote, "The Ark estimates are twice as optimistic as the numbers I would assume. This matters because they are assuming in the example 557 billion miles of revenue, and to do that they think they will need 2.4 million Teslas. I calculate that they would need twice as many cars, and based on their average selling prices and average margins, that would add over 100 billion US dollars of additional capital." And later he writes, Ark's forecasts appear to assume that Tesla don't need to replace the cars, which again shows you how far from reality their projections actually are. What I will do is I will not create such a complex model with a ton of assumptions to be made, and instead I want to keep it much more simple here. Stick to the KISS principle, keep it simple stupid, and only focus on 3 metrics that actually drive the long-term return of a stock. And I try to avoid adding unnecessary complexity, as complexity rarely leads to good investment decisions and outcomes. So the 3 metrics are Tesla's future free cash flow and free cash flow margin, the required revenue growth over the next 5 years, and the valuation multiple Tesla stock will need to trade for in 2027. I will look at the free cash flow multiple. So let's start with Tesla's future free cash flow margins. If we consider Tesla's historical free cash flow margins, we can see that for the most part of Tesla's operating history, the car maker actually wasn't profitable at all on a cash flow basis, and only recently turned profitable in the past 2 fiscal years, and in these years Tesla achieved a free cash flow margin of a little above 9%. And without getting into too much detail here, a 9% free cash flow margin for a car maker without a premium brand like Ferrari or Porsche maybe is already quite a decent result. And 9% is certainly higher than the long-term average free cash flow margins of other car makers like Volkswagen, Toyota or Mercedes, for example. And we also haven't taken into account stock-based compensation expenses of 1.4 billion US dollars in 2022, which would need to be further subtracted from the 5.8 billion in free cash flow that is displayed as free cash flow on the ticker platform. We also did not consider any impact from share dilution. And finally, I would argue that more recently, Tesla's margins are certainly or likely trending downward if you consider the most recent price cuts that Tesla had to announce. Now, to give Tesla the benefit of the doubt here, we could use a 10% free cash flow margin, although to be fair, I think Ark Invest analysts would disagree with me here, as they write in their report that the today non-existing robo-taxi division could, quote unquote, generate software-like margins. But as I said, I want to keep it realistic here, as even the biggest ride-hailing player, Uber, is barely free cash flow profitable yet. So if we now assume that in 2027, Tesla will trade at a free cash flow multiple of 15, which again is above the current valuation of other car companies, if we only consider the profitable ones. And quite frankly, traditional auto stocks usually trade between 6 to 8 times their earnings per share. Well, then we can start playing around with the required revenue growth to get to a market capitalization of 7.9 billion as Ark Invest projects. Well, just to highlight one possible scenario, in this reverse DCF, for instance, Tesla would need to grow its top line, so its revenue, at a rate of 140% in the first 3 years, and then at a rate of 117% annually in year 4 and 5 to reach the price target of Ark Invest, which again is absolutely insane and would translate to a compounded return for shareholders of 73% annually. Tesla's revenue in the 5 years would need to 65x over 5 years and would then be more than 13 times larger than the current revenue of Apple. Now, even for Ark's base case, Tesla would need to grow its top line much faster than the company did in the recent past. But if they do re-accelerate growth, this could translate to a stock return of 54% compounded annually. I'm not saying it's absolutely impossible to hit these numbers. The future is by its very definition uncertain, and of course the stock might trade at a higher multiple or reach a higher level of profitability, but I think it's very, very unlikely for Tesla to come even close to reaching Ark's base case. And if you are now going to argue that Tesla is not a car company, please pause the video here and read this paragraph written by the Motley Fools. So why is Ark's forecast so problematic? Well, obviously Cathie Wood gets a lot of headlines when making such bold claims, and she is invited to financial TV shows like the one on CNBC that I showed you in the intro of this video. But ever since launching her Ark main fund in 2014, the Ark Innovation ETF, she's pocketed more than 300 million in fees despite her poor performance over the last 2 years, recording a loss of 70% in 2022 and 21% in 2021, losing approximately $9.5 billion in investor money over the years. I think it's actually scandalous that the SEC is allowing this kind of promotional and obviously misleading activity and allowing Ark Invest to call their work research. In March of this year, the Ark fund actually received inflows of 397 million in a single day, which represents the largest single day inflow since April 2021, a few weeks after the fund hit its all-time high. So it seems like average investors are still fooled by Wood's marketing tricks, and I would welcome it if the SEC would finally start to step in. Now let me once again quote Stephen Clapham, as I fully support his concluding remarks. I don't want anyone to think that I don't believe that Cathie Wood is a genius. I honestly think she is a marketing genius, but I'm confident that I'm better at valuing businesses.